Hello everyone, welcome to week 7 learning videos once again. In the last video, we discussed about passive screens as a way of implementing value investing. Another strategy that is used by value investors is contrarian investing. In this learning objective, we are going to look at the approach to contrarian investing and reconcile the evidence regarding contrarian investing with the momentum investing that we saw previously. With respect to contrarian investing, you begin with the proposition that markets overreact to different news that released by firms. So if we have market overreaction, what that means is the price will move in a particular direction, but will move too far beyond the fundamental value, and there should be some form of mean reversion. It means that the price come back to fundamental value. Where we see overreaction, what we should see is that an investment strategy that buys a stock that done well recently should actually underperform in the future when that mean reversion takes place. And stocks that have done poorly will actually mean revert and do well in subsequent periods of time. So as we have said, the idea of contrarian investing is based on the notion that investors overreact since it is grounded in investment philosophy where markets are less than perfectly efficient and that there are fundamental biases. Now, there is quite a lot of evidence that supports this notion that markets overreact to news. For example, studies that have looked at markets over a long period of time over a period of many years, for example, have shown negative serial correlation. Negative autocorrelation. So, for example, when markets did well over the previous 5 years, they tend to do poorly over the subsequent periods and vice versa. Similarly, when we look at individual stock, we find similar effects over these long windows. So a key question with contrarian investing is to ask how that actually reconciles with momentum, which is what we looked at last week. It is important that two actually go hand in hand, because in the last week we spoke about momentum investing as being an intermediate horizon phenomena. That is, we look at returns over the last 3 to 12 months, then we invest to subsequent 3 to 12 months, and we rebalance our portfolio over those periods with a maximum rebalancing time frame of 3 to 12 months. With respect to contrarian investing, on the other hand, we look over a long-term horizon. So we might be looking at, for example, a 5-year period as opposed to a 1-year period. And we might recall last week, we said that one of the justifications of momentum was underreaction to news and subsequent overreaction to recent price performance. Overreaction to price, which causes the intermediate term momentum over a long period of time, say over 5 years, to mean revert, which actually provides a justification for contrarian investing. So the idea behind contrarian investing is actually justified by several academic studies. Devant and Taylor, for example, looked at portfolios of stocks that have done well over periods of time and found that they actually subsequent do poorly, whereas the stocks that have done poorly over a period of time subsequently do well. So these studies of contrarian investing look at portfolios of 60 months following the portfolio formation, and as I said, it's a key point of difference from momentum, which look at a period of 12 months. So to look at the evidence regarding contrarian investing, here we have the performance of past losers and past winners across time. And we can see that over this long time period of let's say 60 months, past losers tend to do really well over the long period of time, whereas past winners tend to do really poorly over this long period of time. So there is quite a lot of evidence supporting contrarian investing as an investment strategy. Therefore, if you are thinking about this approach, some important tips for success. First of all, it's important that the contrarian investor has self-confidence. This is one. And also, if you are a contrarian investor and creating a contrarian portfolio for your clients, you need to make sure that your clients have confidence on you. Here, your clients depends on you. because this is an investment approach that basically involves going against the market, going against the heart. It does require patience. It's a long-term investment period. You do need to hold for 5 years or long, so it can result in some short-term volatility. So while an average contrarian investing generates profits over a long time, in the short-time horizon, it can have big drawdowns or it can perform poorly. And like any other trading strategy that moves away from passive investing, you have to watch out for transaction costs and taxes that might incur. That's all for this learning objective.